The IRS is currently tracking every single transaction on your crypto wallet, and one misstep during the 2026 filing season could trigger an automated audit. You are currently staring down a tax bill that ignores your realized losses and taxes your staking rewards at the highest possible tier. But there is a specific accounting loophole professional traders are using right now to legally shield their capital before the deadline hits. Grab a glass of water and let us get right to the bottom of this. First, let us address the elephant in the room. The Internal Revenue Service does not view cryptocurrency as a currency in the way you view the cash in your wallet. To the tax authorities, your Bitcoin, Ethereum, or even your favorite meme coin is treated exactly like property. The same as a piece of gold, a classic car, or a block of real estate. This distinction is the bedrock of your entire reporting strategy. Every time you swap one asset for another, you are triggering a taxable event. Many people think that because they did not convert to United States dollars, they do not owe the government anything. That is a common and expensive mistake. If you bought Solana at $50 and traded it for Ethereum when it reached $100, you have just realized a $50 capital gain. You owe taxes on that $50 profit in the year the trade occurred. Think of it as a ledger that is constantly balancing itself against your initial cost basis. Ever wonder why the records can get so messy so fast? It is because decentralized finance protocols and non-custodial wallets do not automatically send a tax form to the government like a traditional brokerage account would. You are the accountant. You're the one who has to maintain the history. Let us start with the first win, which is simply getting your history organized today, well before the filing deadline. Most people wait until April to scramble through their transaction history, but by then, the exchanges might have changed their user interface or the data might be harder to pull. Use a specialized crypto tax software like Coinly, CoinLedger, or ZenLedger to aggregate your API keys. These platforms pull in the data from every wallet and exchange you have touched over the last 12 months. By having a unified dashboard, you can see your total realized gains and losses at a glance. A friend of mine who day traded through the 2024 cycle spent 3 weeks manually typing entries into an Excel spreadsheet, only to realize he missed 4 wash sales that would have saved him $2,000. Once he synced his wallet to a tracking tool, he found those mistakes in under 6 minutes. That is the easy win. Automate the ingestion of your data. Stop manually tracking your trades. Now, let us level up to the second point, which is understanding the difference between short-term and long-term capital gains in the context of volatility. If you hold a digital asset for 365 days or longer, you qualify for long-term capital gains tax rates, which are significantly lower than ordinary income tax rates. In some brackets, that is the difference between paying 20% and paying 37%. This is massive. Most people treat crypto like a casino, constantly jumping in and out of positions, never realizing that they are essentially throwing away a huge chunk of their potential profit to the tax man. By simply adjusting your holding period, you are effectively giving yourself a raise. There was a study by the National Bureau of Economic Research that suggested retail investors who hold assets for over a year retain roughly 40% more of their wealth compared to high-frequency traders after taxes are paid. If you find yourself in a position where you are planning to sell, look at your calendar. Does it make sense to wait 2 more weeks to hit that 1 year mark? Usually the answer is a resounding yes. It requires patience, but it is the smartest move you can make for your long-term bottom line. If you are finding this breakdown useful so far, make sure to subscribe because I break down complex financial topics like this every single week. We are just getting to the part that most people completely ignore, so stay tuned. Okay, remember how I said there was a method that professional traders use that works better than the first two combined? Here it is. It is called tax loss harvesting. This is the secret weapon for anyone who has invested in the crypto market. Let us say you have some heavy losers in your portfolio. You bought a project at the top of a hype cycle and it is now down 80%. Instead of just holding it in shame, you sell that asset before December 31st to realize a loss. You can use that loss to offset any capital gains you made on your profitable trades during the year. If your losses exceed your gains, you can even use up to $3,000 of those losses to offset your regular income tax, which can lower your taxable income across the board. But wait, here is the nuance that makes this truly elite. Many people worry about the wash sale rule, which prohibits you from selling a stock at a loss and buying it back within 30 days. Currently, in the United States, that rule does not apply to cryptocurrency. This is a massive gray area that you can leverage. You can sell your losing Bitcoin position to claim the tax loss and then buy that same amount of Bitcoin back 5 minutes later. You maintain your position in the market, but you have successfully generated a tax write-off that lowers your overall liability. A tax strategist I spoke with recently mentioned that this single move saved one of his clients nearly $15,000 in taxes in a single fiscal year. Let that sink in. That is $15,000 that stays in their pocket instead of going to the government. Once you see it this way, you realize that tax planning is not about avoiding taxes illegally. It is about being smart with the laws that are already written. Most people are too afraid of the complexity to even look into these tools. They just hope the exchange sends them a form. But you are not most people. You are the one who is actually in control of your digital wallet. So, to wrap this up, we talked about using software to automate your tracking, shifting your strategy to benefit from long term capital gains, and finally, using tax loss harvesting to turn your losing positions into actual financial leverage. That last one is a complete game changer if you are active in the market. If this gave you a clearer picture of how to handle your crypto taxes for 2026, do me a favor and share this with someone who is worried about their filing this year. Hit the subscribe button so you do not miss the next video, where I'm going to talk about the safest way to store your assets off exchange to avoid those surprise tax complications entirely. Thanks for sticking around, and I will see you in the next one. Just remember, the system is designed to reward those who take the time to learn the rules of the game. You've already taken the first step. Keep going.